What was that ugly beast?
Oh, you're asking about the formula.
Yeah, the actual formula is this little m here.
That's about the conceptual. It is 1 plus
1 plus c
over C plus the reserve rate, or R plus E, which is the excessive reserve ratio.
times the monetary base. Good. All right, so that ugly beast is the multiplier. And it's ugly, but it's got the components that we need to tell the right story. Yes?
No, that's the money supply, is that.
Yeah, this is the money supply. So the money multiplier is the base times the multiplier gives you the money supply.
Okay, so billion and
Like, this is like what they used as M1, just for simplicity. So that is the supply of money, which is, and this is where it gets a little confusing. In fact, let's just take a little time here to do this. So the money supply, M1, the definition we had again was what? M1 equals, not this, but currency in circulation. Now this is currency in the hands of the public, not bank vault, not vault cash. So M1 is currency in circulation. This is not vault cash. It's actually out in circulation in the hands of the public, plus, what was the other? The checking account deposits. Specifically those, not savings accounts, not money market accounts, so just checking account deposits. So this was our most liquid measure of money. And the monetary base, the lingo goes is that we call it the base because the base supports the entire money supply. So the base is smaller. The amount that it's smaller by is this multiplier formula. The multiplier formula takes into account the deposit creation process by the banking system, because we're not all holding cash, and banks can make loans and not keep an equal amount that they have on deposits, but rather just a fraction of it. Then that allows the monetary base to be quite a bit smaller than the actual money supply. The things that offset that, just to kind of review last time, is E and C. What was little c and little e? This is what we did last time. So E, Corbin already said it was excess reserves as a fraction of deposit. What does that mean, though? Put that into context for me. What's the intuition behind that? Excess reserves. Why is that important? Does that tend to increase or decrease the multiplier using the equation? If the E is in the denominator and E gets bigger, the multiplier gets smaller, right? So as excess reserves get bigger as a fraction of deposits, then this multiplying effect gets smaller. That's what little e was capturing. But what is E then? There's a little more intuition that I want to make sure we're crystal clear on. So it's excess reserves. What does that mean? If banks are holding excess reserves, they're not loaning out. Yeah, that's the key link that you got to remember, is that if a bank is not loaning out all that they can, then we don't get that multiplier system. So it is kind of a currency drain on the system, similar to when people hold currency in their wallet. So the more currency, the more of our wealth that we hold in the form of cash takes away from the multiplier process. So all this is really capturing is people holding on to cash and banks holding on to cash. All right. So, and this last piece kind of brings up is that, well, cash is part of what we're measuring. So this numerator part flowed into the equation because that is part of the money supply. So they're just kind of battling each other, right? Because as C goes up, this goes up. Well, this goes up a little bit too, but this effect is a little bit bigger as they move. So the relationship between the two. All right, and then we have the required reserve ratio, which I sent you that little email so that you weren't beating yourself up. I didn't want you guys spending time. of 10%, or when you do it in the formula, 0.10 is our assumed ratio. Okay, so with that information, did you guys get your 2.13 for your homework? Okay, once you got that, it was pretty easy. We just kind of plugged and chugged. All right, so our multiplier is 2.1. So let's move on to the next question. And actually, why don't you guys go ahead and start working on all the rest of the questions? I'll walk around. Why don't you guys talk to each other? Maybe I'll give you a nudge here on how that starts off. But so suppose the central bank conducts an unusually large open market purchase, i.e. reality, of bonds held by banks of 1,400 billion due to a sharp contraction in the economy. Assuming the ratios stay the same, what do you predict will be the effect on the money supply? So the hint I'll give you is to start off with the monetary base. We already know this is 2.1, right? So we kind of got this. So what is the effect on the monetary base of an open market purchase of $1,400 billion? Because we did not have to calculate the monetary base technically in the first one. The monetary base? Yeah.
But C plus R 15 or 101.
So we got the excess reserve. That's the piece that we got to grapple with a little bit is the reserves piece. We've got the excess reserves. And then we got to figure out the required reserves. So the R, the big R, is both.
So you have to see what the effect is on the monetary base first, and then you see what the
Yep.
effect is on the monetary base.
So the monetary base is reserves, total reserves, plus currency.
It's also currency in circulation.
Oh, right.
Russ, do you have?
Mine is from this times.
Should we just take that 1,400 and add it to the original monetary base?
Yes.
What'd you get, 3%?
So that's correct. So if you take the 1,400, what we went over in that previous stuff was that when the Fed does an open market purchase, it doesn't matter if a person buys it or a bank buys it, it's going to lead to an increase in reserves of 1,400. So yes, that does lead to an increase in the monetary base. So the key to this one is the reserves is required reserves plus excess reserves. And the required reserves, we assume with our assumption that it's 10%. Now you know that deposits are 900, so 10% of 900 is 90. So that's the amount of required. And then we're given what the excess reserves are. On that, so that's 90. And then we've got the excess was 15, right? Just given from the problem. So that's the amount of reserves plus the amount of currency, which is given to us as 600. So that was the original monetary base. And now we added 1400. And then you pretty much just use the formula, the 2.1 times that.
And then we add 1400.
Does that look about right?
And then
I don't have my sheet here, but what did you do?
So we took the 2.12
1400.
times
You missed the 15.
well, it's just
So what?
deposits times C plus R plus C, and that will get you your original
No,
monetary.
you got to calculate the new monetary base, the total amount of the base, and then multiply that times the 2.1.
I understand, but to get the original monetary base, that's what we did, because that's what we had as one of our equations.
Oh, you took worked it that way. Yeah, let me see. That might.
Because if that throws you off.
I think that's fine.
90 is 900.
2105. What did you get for the original monetary
It
base?
was like 19.
Oh, you just took the deposits.
But that's what you're supposed to do. That's what we had as one of our
Now,
equations.
let's just start. I don't know. There might be a backdoor way of doing it, but I think if you just think about the monetary base of currency plus required reserves and excess reserves, that's the monetary base, and that's the Fed liability. So just that was the starting monetary base, and then we just added the 1400. So it's currency, and the little extra thing you had to do was the 900 billion. Take 10% of that is 90. That was the amount of required reserves, and then the problem gave you the 15.
Okay.
How you guys doing?
And the year, are we keeping this 1400 billion, or are we loaning it back to people?
The base, so good question. The thing that the base is going to increase by 1,500. So Mallory just asked a good question. That's the reason I put this up here. So let me come back. Let me have your attention for a sec, because this is kind of the weird thing about the multiplier process. So this was the increase in reserves of 100 million. For this problem is 1,400 billion or whatever. So we did an open market purchase. And then that becomes a loan that goes into another bank, right? And then they keep 90% of it, 10% is required reserves. Then they loan it out. We kind of focused on the loaning part, but check out what happens at the end of the day in terms of the Federal Reserve. Once all the money gets loaned out, that 100 that was the open market purchase ultimately lands itself into reserves. That's the other part of it, right? So that's why we can use the monetary base. The full increase of the 1,400 is factored into, that's how much the base went up. Now, the leakages through excess reserves and currency drain, that's captured here with the multiplier. Okay, but the base went up by the full 1,400. Okay, so what did you guys come up with for answers? It looked like most of you are about there. What was the new money supply? 4,479 or 83. There's probably a little bit of rounding going on here. 0.65 billion.
I just did.
So there's your number. And again, you might have a little bit of rounding error if you're close to that. All right. Any questions on that step? We'll just kind of take it one at a time. You guys okay back there? Nicola? Yeah? All right. Suppose the central bank conducts the same open market purchases in B, except that banks choose to hold all of these proceeds as excess reserves rather than loan them out due to a fear of the financial crisis. Assuming that currency and deposits remain the same, what happens to the amount of excess reserves, the excess reserve ratio, and the money supply and the money multiplier? So we got a number of things that we need to chip away at. So they're going to take that 1,400, but because they're a little puckered up with the financial crisis, they're going to say, man, I'm not loaning out a dime. I'm going to take that 1,400, but I'm just going to sit on it. So you're going to have to recalculate little e, right? right? You're going to have to recalculate little e and see what the effect is. And your very first step might be to think about what is the new level of excess reserves going to be. And it's 1,400. I know it seems obnoxiously big, but that's the new total. So that's big ER. That's big ER. But then you're right. The deposits will stay the same. So then you need to recalculate little e. So so you had an increase by, but you had the new level. Okay, good. Yep, 14, 15. In it? Okay, good. Now channel that sucker through the rest of it. You should come up with a new multiplier. And then you're pretty much home free because the monetary base changed by the same amount as it did for Part B. It's just the multiplier change. Okay, yep, that's good. And now channel that back into that ugly multiplier, and you'll get a new multiplier. All the other parameters stay the same. As soon as you get the new, let's see, the new multiplier, why don't you let me know what you came up with?
I got 0.7126.
0.7126, that sounds correct. So pretty close in a second. So 0.71 is the new multiplier, which seems kind of weird for a multiplier to be less than 1, right?
Right.
But you guys are right. But that's what this problem is forcing us to think about. What's the new money supply then? The monetary base did change. So the monetary base changed by the 1,400. So that's all the same. What is the money supply? No. So what'd you come up with the money supply for problem 1 with the new multiplier?
It's
1,500 is the new money supply?
Yeah.
So what did you use for the monetary base?
600 plus 90 plus 1415.
All right. So you got the 2105 times the 0.71 gave us the 1,500.
Yeah.
Yeah, that's what I got.
All right. So, Michael, you want to go over these little guys?
Yeah, what is?
C is the amount of currency as a fraction of deposits.
What is that number?
The same.
Still two-thirds. Okay.
Yep. 600 divided by 900.
Yeah, so it's 1450.
All the excess, yeah. So the new E is the one that changed. E is equal to the excess reserves divided by deposits is 1415 divided by 900.
It's not people putting money in like, hey, we'll come back to this. It's the government, like, here's all this money, and they're like, it's in our vault now.
Yeah. Yep, it's just sitting there. Okay, so part D. Is everybody all right on C? So part D. Following the financial crisis, the Federal Reserve began injecting the banking system with massive amounts of liquidity. At the same time, very little lending occurred. As a result, the M1 multiplier was below 1 for most of the time through 2011. How does this relate to your answer in part C? Does that make sense? Right. Yep. So holding on to it does nothing in the real world. So we have some graphs of what the actual financial crisis looked like here. So after the financial crisis, Federal Reserve zaps up the monetary base, but the level of the money supply stayed flat. So we kind of see that was the actual, using the actual data, that's what happened during the crisis. So what kind of flew in the face for me, because some of my predictions, along with many other people, was that, hey, you increase the money supply, that's going to be inflationary. We haven't seen that inflation yet. That's what the quantity theory of money would tell us. But that is based upon an injection of the money supply being followed by business as usual as far as loaning out that money. And so by the banks countering that by not loaning it out, because of course they're not forced to loan it out. If they want to hunker down and be safe, then there ends up being no effect on the money supply. And so ultimately, the relationship of the quantity theory of money still holds, because we need the money to be out in circulation, not held within the banks. And so if that remained flat, then inflation remains flat. And so that does still work together. It's just we broke this link of the Federal Reserve taking action, followed by there being consequences with inflation, and that didn't happen during the financial crisis. Okay, let's see, I think the first slide, but the second one here too shows what happened with the excess reserves ratio. So, excess reserves ratio, what does that mean? What does this mean? None, right? Yeah, we're loaning all of our money. The Federal Reserve tells me I got to hold back 10%. That's exactly what I do. I keep it right on 10%, right? I'm not gonna hold anything back. Then we start to quake in our boots, and we're like, oh, we need cash. Oh, we need a lot of cash. Oh, let's just ride this thing out. And it climbs. The currency ratio stayed pretty flat, but it's slightly declining. So as the economy slumped, people started to hold less cash as a fraction of their deposits.
So is this excess reserve ratio, is that like an average for all banks?
Mm-hmm.
Federal Reserve members?
Yes. Yep, that's the average for all banks. So some banks that were in trouble probably didn't have the luxury of holding on to excess reserves, and they had to actually start to meet their required reserve requirements. So yeah, this is just average of all banks. Okay. All right, anything else there? So there's some other interesting slides of a previous time of financial crisis that the book works through here. And this is the Great Depression. So here is 1929, and this again is deposits of failed commercial banks. So what was happening with failed commercial banks as we went through with deposits? And so pretty crazy with banking panics and some failing and some coming back. So the crisis period is right in that 1930s range. How did that correlate with some of this other stuff? Yeah, we didn't see the same effect as before, right? So we had excess reserves is measured over there. This is the ratio. So with this graph, we've got the excess reserve ratio being measured there, and the blue is the currency ratio. So slightly different than what we saw with the recent financial crisis. What's happening with currency now? Is that climbing or decreasing? Like
whatever the excess reserves ratio goes down, it's relative.
yeah. Kind of see these two things going up together. So I had a little bit different effect. But similar in that banks were starting to hold more excess reserves and offsetting movement. The Milton Friedman and other people thought that where the Federal Reserve screwed up with the Great Depression is right in here, that they didn't inject more funds, they didn't make funds liquid during that time, which might have helped ease the pain of the Great Depression. And that is why there was a bigger move. There was a bigger move with this last recession to change the monetary base. So here's the base. Stayed flat the whole time. Here's M1. So they allowed a major contraction of the money supply, which then made it more and more difficult to do business. So Milton Friedman pointed out that, or was one of the early researchers pointed out that was how the Great Depression happened, was that the Fed didn't provide enough liquidity. Had they been being more consistent with that, then it might have softened the blow. Certainly wouldn't have eliminated it. I don't think they could have managed their way out of it. Okay. So, your other sheet on the flip side, oh wait, not the flip side, I didn't even, yeah, I did, that's right. Did I pass that out? Yeah. So, I want you to rewrite that formula. That's another table from your book. And just in your mind, let's go through, and the reason I printed it off so that you guys could make notes to each other, I really want you to have this formula kind of make sense to yourself. So rewrite the formula on that sheet. This one we started off with. And something we're going to roll into the next chapter on is the breakdown of the monetary base in terms of non-borrowed base and borrowed base. So borrowed reserves are money that banks went to the Federal Reserve for and borrowed. Remember that being on the balance sheet? So that is part of MB. So within this chapter, it might have even been previous chapter, the monetary base is broken down into the, what was the notation we used? MBN for non-borrowed monetary base plus borrowed reserves, BR. And so we want to think about how much reserves are existing because they were borrowed from the Fed versus the reserves that are existing just kind of free market, that are just floating out there because of deposits. And that's going to end up playing a role later. Here, that makes no difference in terms of changing the money supply. So if the Federal Reserve has an increase, if there's an increase in non-borrowed reserves, that will lead to an increase in the money supply. And same thing with borrowed reserves, will lead to an increase in the money supply. So that follows this formula. This goes up, this goes up. Required reserve ratio then plays into that. If R goes up, money supply goes down, right? So the denominator's getting bigger, everything else held constant, assumed, and that's going to make the money supply go down. Okay, and then that plays into just this borrowed reserves, that increase in that makes that go down. Excess reserves, if excess reserves go up, they're holding on to excess reserves. That means there's more of these floating out in the system. That means this goes up, which makes this go down. And then currency holdings. So as people hold more currency, if this goes up by with the other factors, causes the money supply to go down. And the monetary base is going up with currency as well. Okay, so if this is, what was our excess reserves ratio from the other 001 or
1/60.
point what? 1/60. Let's just call it 0.01. And the required reserve ratio is 0.1. And if currency, what was the currency here? 0.67? 0.66? Okay. So this is 1.66 for starters. So if this goes up to 0.76, so if the change in this one is 0.76, this goes up by 0.1. And what does this go up by? 0.1. So what happens with the change? What happens with the multiplier? So let's just do it. You guys, we already know the answer was 0.1. So if that's 0.76, what's 1.76 divided by, what does this end up being? 0.861? This one ends up being 8.7? Yeah, we should use the exact same numbers, otherwise it'll, whatever it was before. So what is the new multiplier, M1? The first multiplier was 2.1, we have it written down here somewhere, don't we? 2.13? What does this one end up being? What does it equal?
Original one is 2.16, and the new one is 2.0229.
And this was approximately what I had, right? 0.86?
0.87.
0.87. Okay. Why would that is a little bit weird. If we think about the percentages of how they changed, they're not quite the same, right? This one had a 1 up here, so when we add 0.1 to that, it's a relatively small change. When we add 0.1 down here, it's a relatively large change. So this one proportionately is changing bigger than the upstairs, and that's causing the multiplier to fall. All right. Let's see, so we worked through that. Okay. So, let's see, I don't know if we're going to get to this. Let's go. Yeah. Hold on, I can't hear that thing going up. Go.
Excess reserve ratio is over 1 with the money multiplier.
Yeah.
The original excess reserve.
You mean how we got like to 0.71 down here? I mean, the problem that we worked through, the multiplier ended up being 0.71.
Yeah.
So it was actually less than 1.
And then if you had the same increase in currency there, then the money multiplier would actually increase, wouldn't it?
Probably. That sounds about right. Yeah. I think intuitively, because then you're flipping the relationship between the numerator and the denominator. Yeah.
Okay, so then this, when this is all the time, then the money supply would always decrease.
Right. That table is written for kind of normal circumstances. So we kind of went through abnormal times. I don't know if it maybe doesn't say that, but normally the multiplier is greater than 1. So what we've really found is kind of an oddball case of where this formula is much more complex than what this is. This is kind of like under normal circumstances, this is how the world works with the multiple relationship between the monetary base and the money supply. But under unusual circumstances, then we still, if the Fed prints off money, let's think about it this way. If the Fed runs off money and just gives it to somebody, monetary base goes up by 100 billion. Money supply goes up by 100 billion, if nobody's loaning it out. So if they run the printing press, then it's a 1-to-1 basis, right? If there's no other changes going on. So we kind of run into what we call a corner solution in economics, where if some oddball things happen, like the math doesn't work out, the math stops working, the math only works within a certain range. Okay? All right, so let's see, chapter 18.
I have another question.
Yes.
Okay, can you explain how the currency affecting the multiplier is different from the currency affecting the like the monetary base will be held constant when the multiplier is changing?
That currency, holding other things constant, that currency, if people are holding, then deposits went down. So the base is reserves plus.
Oh, so you're just moving money around and not adding anything to the system?
Right. In that case, yes. Yep.
Go down, then you would still have a change in the ratio aside from C, because E would change.
Right. Right.
And so therefore, if you wanted to base still.
No, but if deposits go down, it's what I'm saying. Oh, but if it goes.
It goes into the same effects.
Okay. So chapter 18. We're just going to kind of get a little warmer up. We don't have too much time left today, so I just kind of want to get the feel for where we're going with this reserves thing in terms of interest rates and open market purchases, and how the Fed really works there by entering in the market for reserves. So we're going to introduce the market for reserves. And what's going to be a bit unusual is some different interest rates that are going to be put into effect. So what are reserves? Good. So excess reserves plus required reserves. I kind of wrote it different, but so required reserves plus excess reserves is the total amount of reserves out there. So now we're going to think about how banks actually make maneuvers on their money in order to maximize profits while staying liquid to be able to service the day-to-day transactions. So on any given day, banks might be sloshing things around with borrowing some money from other banks to meet their required reserve amount. So our little r is the required reserve ratio set by the Fed. That's 1 R. Our new interest rate we're going to introduce that we've mentioned before is the federal funds rate. The federal funds rate. IFF. Does anybody remember what that rate is? Federal funds rate. I think it's been mentioned a few times off and on. No, not the Fed. You were close, like you had to potentially say the right answer right up to the last word. So change the last word. The rate that banks can borrow from other banks. Yeah. So from the Fed, what's that rate? The discount rate. All right. So we're making that distinction now, and see how that plays into things. So the federal funds rate is the rate banks charge each other for very short-term loans, usually overnight. Very short-term loans, like overnight. Could be a couple days or something depending on the circumstances, but very short-term loans. Okay, and then the discount rate, ID is the discount rate, which is the rate the Fed charges for loans. And then we've got a new one that we have not talked about yet this semester. It used to not exist. The Fed historically paid 0 to banks. The Fed historically paid 0 to banks. They were just forced to do it. They had to hold back a certain amount, and deposits at the Fed were paid 0. How much do they get paid on vault cash? So remember, there's required reserves. Required reserves are deposits at the Fed and vault cash. How much do they get paid on holding vault cash? None. So it was kind of fair, right? It was either 0 in both places. Well, in 2006 or 8, the Fed had been pleading for a number of years to allow them to pay banks some amount of interest on that. So that's our new interest rate we're going to introduce is OR, I think, first. Just to keep things consistent here. Oh, is it ER? Geez, my eyes are getting bent. No, it's OR. Yeah, the excess reserve. All right. I can't quite see it. I think I'm pretty sure it's IOR. And this is the rate the Fed pays banks for deposits at the Fed. And then we'll put in parentheses, this is part of required reserves. It's the reserves payment, and I can't remember what the O is. That's why I think it's O. So OR is it. You know, I think they actually changed, little notation. So we will conclude there, and I will know what O stands for. You know, it's not in my notes here. I think the book actually changed their notation. So we'll call it a day there. We'll see you on Monday. Happy Halloween.
I was intending to help with the math club.
It starts at 5:40. Like Amanda's gonna set up her all the stuff is in Dr. Pinker's office right now. And so she's just going to go and call security and
Well, they didn't even tell me what the O is.
Is that the only time you need me, or do you want
I
me
could
to
make
remain?
something up.
I mean, I would love for you to help me in the booth, but I just think you were really busy.
Oh, thanks.
It's either you can either set up, I would like you to either
You need help for rest of
is that guy with you?
Huh.
I mean, yeah.
That is just not good economics, or mathematics for that matter. Yeah, the interest rate charge on these reserves. I mean, they say it's fair. Usually the OR would correlate with what it's called. They just say the interest rate placed on reserves is IOR. I wonder if it's because they're trying to highlight OR.
Would that be
It
it?
is
Well,
O.
it ends at 8.
Ah, never mind
So
then.
maybe like
Because I thought it
7.
started at 7.
No, it starts at 6, it ends at 8.
Starts at 6, ends at 8.
Huh.
In that case, I'll show up at 7.
Okay, thank you, Corbin.
Not a problem.
That is strange. All right, what's your question? I can dig on this later.
I just wanted
No,
to
I'm
give you a
curious.
heads up that there's going to be